Welcome to the Deep Dive, the place where we take the densest, most complex data, whether it's market reports, quarterly earnings, or regulatory filings, and really try to distill it into clear, valuable insights for you.
And today, we are wading into, well, a truly turbulent environment. We're doing a deep dive into Braskem, ticker BAK. It's a massive petrochemical company that's currently sitting right at this volatile intersection of the global chemical supercycle and the, let's be honest, extremely pressured Brazilian economy.
Yeah.
It's really a textbook example of a company fighting on multiple fronts, simultaneously.
And you can see the fight is brutal right now. I mean, if you just look at the stock performance year to date, Braskem's had the worst drawdown among its entire comparable peer group. The market is just pricing in immense immediate pain. But here's the challenge, right? The thing that makes this deep dive so necessary. Beneath all that negative headline noise, the sources we've looked at reveal actual underlying signals. Signals suggesting that the company's fundamentals, despite those really shocking Q2 numbers, might finally be bottoming out.
And that tension, that's really our mission today. We've analyzed the Q2 2025 consolidated data, the detailed segment reports, the structural overhaul documents.
Yeah.
We really need to dissect the company's operational liabilities, these two massive historical issues that keep surfacing, analyze that staggering current debt load, and, crucially, evaluate the viability of their ambitious transformation program.
Yeah.
We're searching for those critical signs of, let's call it, structural resilience that might be hiding beneath these quarterly shockwaves.
Okay, let's start with the macro environment then, because the external pressure on Braskem, I mean, it's a Brazilian company, it's just immense. We have to talk about the currency strain first.
Absolutely.
The Brazilian real, it's collapsed almost 18% against the US dollar in the last 12 months, basically hitting its lowest point since the peak of the COVID crisis.
That currency move alone, well, it creates a monumental headwind.
Yeah.
You've got a company like Braskem generating revenue mostly in reals,
Right.
but holding a lot of its substantial debt load denominated in US dollars. So every single drop in the exchange rate makes servicing that debt way more expensive in local currency terms.
Instantly.
Instantly, it just tightens the screws on liquidity, on profitability. It's like an unavoidable tax on every single thing they do in Brazil.
Okay, so that currency fight is just compounding what's already a punishing global industry environment. Petrochemicals, I mean, they're not like tech or consumer goods. They operate on these notoriously long, deep cycles.
Absolutely. The chemicals industry is defined by massive capital expenditures, CapEx, right, on plants that take years to build and, frankly, decades to pay off. Our historical analysis shows the industry tends to see its operating margins bottom out roughly every 4 to 6 years.
4 to 6 years, wow.
Yeah, and this isn't just a quick dip. It's a sustained period where global oversupply, maybe lagging demand, just squeezes every dollar of potential profit. And we are firmly entrenched in one of those troughs right now, probably caused by, global expansion coupled with slower demand growth post-2022.
Okay, so we know we're in a trough. But you mentioned earlier, the sources suggest the arithmetic, the numbers, are starting to contradict the market's immediate sort of negative story about Braskem's stock. What's this counter-narrative hiding in the margin data?
Well, the main argument for a potential bottom really rests on a pretty simple historical correlation. Historically, Braskem stock bottoms out precisely when the industry margins, specifically those spreads between feedstock costs and finished product prices, bottom out.
Okay.
Now, if we analyze the margins on a trailing 12-month LTM basis that smooths out the quarterly noise. Yeah,
Right, takes out the bumps.
exactly. We see clear indications they started inflecting positively over the last, say, 2 to 3 quarters. So if history is our guide here, the stock maybe should have already seen its cyclical low.
That sounds like a pretty powerful signal. Suggests the worst might be over from that perspective. But then there's this confusing divergence, right? When we look at another key historical indicator, why isn't the stock responding to the wider global signals then?
Yeah, this is the divergence that really worries analysts. Braskem stock has also historically correlated pretty strongly with global manufacturing health. Specifically, indicators like the S&P Global Manufacturing Output or the ISM Manufacturing Output. Those global indicators for manufacturing activity, they clearly bottomed out back in late 2023. And in every previous cycle, the stock would usually begin its recovery shortly after this global macro indicator confirmed the manufacturing trough was passed.
But this time, the stock has just stubbornly refused to recover.
Correct. It's shown a really clear divergence from that historical precedent. And this suggests the market is focused much more on company-specific, idiosyncratic risks, the issues we're going to get into later,
Right.
rather than simply believing the macro rebound will lift Braskem too. The market's essentially saying, yeah, okay, the cycle is turning, but Braskem has way too much baggage to join the party.
And that baggage, it became painfully apparent in the immediate Q2 2025 financial snapshot. Let's face it, the headline numbers were brutal.
Brutal is exactly the right word. Consolidated recurring EBITDA. And we focus on that because it strips out one-time impacts, gives a better sense of operational profitability. Yeah. It plummeted to just US $74 million.
$74 million.
Yeah. Compare that to Q1 2025. That's a sharp 67% drop. And year over year from Q2 2024, a staggering 77% decrease.
Wow.
This isn't just a slowdown. It's like an operational collapse in profitability for that quarter.
Okay, let's unpack the anatomy of that collapse, because it wasn't just cyclical weakness, was it? What were the immediate factors driving that massive EBITDA drop?
It was really a toxic combination. External market forces colliding with internal timing issues. First, you had reduced international spreads for key products like polyethylene, PE, and PVC. They were just selling the finished product for much less profit globally.
Okay, lower prices.
Lower prices. Second, they had scheduled maintenance shutdowns, particularly hitting their crucial Mexico segment, which reduced volumes.
Right. But the single biggest financial hit, the one that just disproportionately crushed the profitability calculation, was what they call the inventory mismatch effect. This sounds technical, but it really needs a clear explanation if you're trying to understand their income statement.
This is absolutely crucial. Imagine Braskem bought a massive quantity of its main feedstock naphtha or ethane back in Q4 2024 or Q1 2025. Global commodity prices were elevated then, right?
BAK.
They paid a high cost for that material. But accounting rules mean that high-cost feedstock doesn't hit the cost of goods sold, the COGS line, until the finished plastic resin actually sells.
Right. So fast forward to Q2 2025. They're selling the finished product at market prices that have dropped significantly because of the downturn. But the COGS flowing through their income statement is inflated by that expensive stuff they bought months earlier.
Precisely. You've got current low sales revenue meeting past high input costs. This lag effect just systematically severely compressed margins across every single segment. It caused this massive profitability gap that was completely unavoidable, really, regardless of how efficient the plants were actually running in Q2.
Wow.
It's an accounting headwind. It will eventually reverse once the cheaper current period feedstock flows through, but for Q2, devastating.
And when you put all those factors together, the low spreads, the shutdowns, and that inventory lag, the result was a shareholder net loss for the quarter of US $45 million, or $267 million in local currency. That number immediately validates why the market is so nervous.
Yeah, absolutely. And that financial pain leads us directly to the structural issues, the things that continually spook the market, and crucially, any potential strategic buyer. We have to move beyond just the cycle now and talk about these two enormous company-specific operational and social issues that have served as persistent overhangs.
Okay, starting with the most infamous one, the geological event in Alagoas. I mean, this is the definition of a long-tail liability, isn't it?
It absolutely is. This refers to the historical salt extraction operations down in Maceió. It led to significant ground subsidence, forced the relocation of thousands of residents, just severe socio-environmental issues.
Yeah.
It's a tragedy, really, that's become this massive non-financial black hole for Braskem. And this issue alone has been cited as a primary complication in the attempts by Novonor, the largest shareholder, to sell its controlling stake.
The financial provision for this disaster is currently what, our $4.7 billion as of June 2025? Does the execution progress they're reporting suggest that most of the, let's say, financial hemorrhage is now behind the company?
Well, in terms of the immediate human cost and the relocation efforts, the execution has been pretty impressive. It shows a deep commitment to resolution, you have to say that. The Financial Compensation and Relocation Support Program, the PCF, it's practically complete. They've submitted 99.9% of all anticipated proposals. That's over 19,000 households.
Oh.
And they've paid out 99.4% of those proposals, distributing over $4.2 billion. So the vast majority of the cash outflow for that immediate financial compensation to affected residents, that's already happened.
So the relocation pay and the cash for that is largely done. What about the physical stabilization of the area, that mine closure plan involving those 35 salt cavities? How's that going?
That's the next challenge, and it's a massive engineering undertaking. The plan focuses on stabilizing those 35 cavities. 18 were identified for priority filling using solid material. Now, 6 of those 18 are fully completed, 5 are currently in progress, and 6 others were deemed naturally filled. This work requires intricate, constant coordination with the A&M, the National Mining Agency.
Right.
For example, they just recently received approval for the natural filling of Cavity 18, which actually experienced a partial collapse late last year. So it's ongoing, complex work.
That sounds like heavy execution, definitely. But I want to introduce a point of, well, critical skepticism here based on the source material we read. If they've paid out $4.2 billion and have a provision of $4.7 billion, that doesn't leave a whole lot of wiggle room, does it?
Not much.
And the source explicitly warns that the eventual cost might differ significantly because the subsidence is dynamic. There could be future claims. Is that current provision fundamentally unreliable for a multi-decade issue like this?
That is the critical risk, exactly. While the current execution addresses the known compensation costs, the long-term liability is far less certain. You're absolutely right. The provision covers the estimated cost of the current remediation plan and the PCF. It likely doesn't fully account for, decades of required monitoring, perpetual stability concerns, maybe potential new claims arising from areas only subtly affected now.
Or just new engineering costs if things get worse.
Exactly. The subsidence accelerates unpredictably. This $4.7 billion, you have to see it as the floor, probably not the ceiling. And that ambiguity is precisely why this liability remains such a significant deterrent to potential buyers who are looking for predictable risk.
Yeah, that really puts the magnitude of the problem into perspective. Okay, let's shift gears to the second massive operational crisis, the Braskem-Idesa joint venture in Mexico. This sounds like it was almost a self-inflicted wound by their supplier, PEMEX.
It was a disaster created by, frankly, terrible political prioritization. The Braskem-Idesa plant relies on ethane feedstock supplied by the Mexican state oil company, PEMEX. The analysis points out that PEMEX, rather than investing in the sustaining capital expenditures needed to maintain its infrastructure and ensure reliable supply, was continually deferring that crucial capex. Why? To fund immediate social programs.
That's the absolute textbook definition of killing the golden goose, isn't it? Sacrificing the commercial long-term health of your infrastructure for immediate political spending.
Exactly. And this unreliability, it was compounded by a general maintenance stoppage initiated in Q2. It led to a catastrophic utilization rate drop. The plant plummeted from running at 79% capacity in Q1 2025 down to a staggeringly low 44% in Q2 2025.
44%.
Yeah. That 35 percentage point drop means massive unutilized fixed costs and consequently PE sales volume dropping 33% year over year in that segment. That kind of drop just pushes a plant deep into negative territory financially.
Yeah, so the reliance on PEMEX just had to end. And the solution, this TQPM ethane import terminal, it came online at precisely the right, if maybe delayed, moment.
This terminal is absolutely the long-term fix for the Mexico operation, and it's an essential piece of Braskem's overall strategy for feedstock flexibility, which we'll talk more about. The terminal was completed in May 2025. Crucially, it has the capacity to import 80,000 barrels of cheap, stable U.S.-sourced ethane per day. That's 120% of Braskem-Idesa's maximum needs.
120%, so plenty of capacity.
Plenty. This means the plant is no longer beholden to PEMEX's unreliable domestic supply. It radically transforms its commercial viability going forward.
Wait a second, so they financed a $586 million terminal to mitigate their biggest operational risk in Mexico. Andy, they actually recorded a financial benefit related to the delay. That sounds like incredible financial engineering. How was that construction financed, and what was that unique revenue stream?
Yeah, it was handled pretty shrewdly, actually. The majority of the U.S. $586 million construction cost was financed via a syndicated project finance loan arranged by the terminal operator TQPM. This was critical because it minimized the need for cash contributions from Braskem-Idesa's shareholders during a period when that joint venture was under severe financial stress.
Right.
Furthermore, because of contractual protection clauses related to the construction timeline, the Mexico segment was able to record U.S. $27 million in net revenue. This came from a contractual fine it's set to receive specifically for the delay in the terminal's completion.
That's amazing.
It's rare, right? To mitigate a huge risk and actually receive a significant financial payment against that same risk. It offered a small silver lining to a very stressful period for them in Mexico.
Okay, now we shift our focus to the company's overall financial bedrock, which is, well, undeniably strained. The problem, as we've kind of alluded to, is that terrifying leverage ratio.
Yeah, we need to put the debt into context first, though. Total corporate debt sits at U.S. $8.5 billion. Now, while that's large, the structure itself offers a degree of comfort. The average maturity is approximately 9 years.
9 years, okay.
And critically, there is no major debt wall requiring refinancing until 2028. This long maturity profile gives management some much-needed breathing room to navigate this cyclical downturn without immediate liquidity fears breathing down their neck.
But when we look at the leverage metric the market really watches, that adjusted net debt relative to recurring EBITDA for the last 12 months, LTM, that breathing room just disappears, doesn't it? Because the EBITDA collapsed so much faster than the debt could be managed.
It's exactly. The ratio ballooned to an alarming 10.59x. Now, to understand why this number is so critical, you need context. For a highly cyclical chemical company like this, a healthy leverage ratio might be, say, 2.5x to 3.5x.
Okay.
During a trough, maybe it briefly touches 4x, maybe even 5x. But a number over 10x, that is an immediate flashing red flag.
Yeah.
It represents a 33% increase just from the prior quarter and a massive 56% increase year over year.
So what are the real-world implications of that 10.59x figure? Does it actually trigger debt covenants, or does it just scare off M&A deals, or both?
It really does both.
Oh.
While Braskem has been smart about staggering its debt maturities to avoid immediate breach, that level of leverage dramatically increases their cost of borrowing going forward, and it immediately triggers increased scrutiny from their lenders. You can be sure of that. More practically, though, it acts as a massive deterrent for any potential buyer, including those supposedly performing due diligence right now. A buyer would look at that 10.59x and demand either a massive discount on the price or an immediate credible plan to deleverage. And that plan likely requires selling high-value assets, which, as we'll see, the current management is resisting. It is the single most compelling reason the stock is underperforming those macro recovery signals we talked about.
Okay.
The market is basically pricing in either massive equity dilution down the road or forced asset sales.
We also noted significant cash consumption in Q2. Let's clarify the nature of that cash burn. How much did they consume overall? And you mentioned there was maybe some good news hiding in the operational figures.
Yeah, overall, the company recorded a total cash consumption of $1.448 billion. That's roughly US $256 million in Q2 2025. Now, that sounds like a disaster, right?
It does.
But the analysis is a bit more nuanced. Let's call it good news, is that the core operational cash consumption was actually lower quarter over quarter. It stood at $175 million.
Okay, so why the huge difference between the total cash consumption, our $1.4 billion, and the operational consumption of our $175 million? Where did the rest go?
Well, the over $1.448 billion total included things like those execution payments for the Alagoas liability we discussed, scheduled debt servicing payments, and some specific non-recurring CapEx. The lower $175 million operational figure shows that management's efforts to optimize working capital and aggressively manage inventory, even during that really difficult inventory mismatch period, did actually mitigate the immediate cash hemorrhage from the running plants.
Oh, okay.
It suggests that while the P&L was getting crushed by those accounting lags, the day-to-day cash management was improving, preventing an even worse liquidity crisis, perhaps.
That distinction is crucial. Okay, let's apply these insights now to the regional performance breakdown, because the story is really divergent across their global footprint, starting with the core Brazil-South America segment.
Right. This is where we see the first clear signs of that transformation thesis starting to work, potentially. The overall utilization rate for the segment was stable at 74%. But what's fascinating here is the performance of the gas-based plant down in Rio de Janeiro. It operated at a highly efficient 95% utilization.
95%.
Yeah, this heavily underscores the economic advantage of using gas feedstock over the traditional, more expensive naphtha.
Okay, but despite that operational strength in Rio, the Brazilian segment's recurring EBITDA was still down 24% quarter over quarter. It settled at US $152 million. So can we safely assume the primary culprit there was still that inventory mismatch effect?
Precisely. Even the healthier operations were financially penalized by that accounting flow-through of past high-cost feedstock colliding with present lower sales prices. And that was compounded by the unfavorable exchange rate movements we talked about earlier.
Right.
So the profitability drop wasn't really a reflection of local operational inefficiency in Q2, but more a system-wide accounting headache.
But was anyone actually buying plastic resins in Brazil during this time, or was the demand picture also depressed?
Actually, the domestic demand signal was surprisingly robust. Resin demand in the Brazilian market grew by a solid 7% quarter over quarter.
Okay.
Now, this growth wasn't necessarily driven by soaring economic optimism. It was more customer anticipation of future price increases.
Oh, buying ahead.
Exactly. Customers, seeing the cycle potentially bottoming and maybe future price hikes coming, pulled forward their purchases, especially for polyethylene and polypropylene used in things like packaging and industrial sectors.
Okay, interesting. Now let's look overseas, starting with the U.S. and Europe segment. You mentioned stable utilization, negative profitability here.
Yeah, the stability of the operation is kind of misleading. Utilization rates held at 74%, pretty much in line quarter over quarter, and sales volumes even increased slightly by 2% due to seasonal U.S. demand.
Okay.
However, the segment reported a negative recurring EBITDA of U.S. $8 million.
Negative $8 million.
Yeah.
Wow.
This is a severe indictment of their current cost structure in that segment. Even with stable demand and slightly higher sales volumes, that inventory cost mismatch was so severe it tipped the entire segment into loss territory. It really shows that in a global downturn, these assets, many of which are older Dow acquisitions, remember, they just cannot generate cash flow when feedstock costs are misaligned like they were in Q2.
Ouch. Okay. And finally, Mexico. We already identified it suffered those catastrophic utilization drops because of the PEMEX supply problem.
Yeah, the result was predictably devastating. Mexico reported a negative recurring EBITDA of US $9 million. This was a direct result of the major operational issues we discussed, the mandatory shutdown, the critically low PEMEX supply, and have to recognize US $9 million in idleness expenses related to that shutdown process.
Right.
Q2 2025 was absolutely the low point for the Mexico segment, structurally, operationally, and financially. Hopefully, the terminal changes that picture dramatically going forward.
Let's hope so. Okay, now that we've fully covered the immediate pain and those structural overhangs, we have to turn to the survival blueprint, Braskem's transformation strategy. Management has basically staked the entire company's future on this program, right? Arguing it's non-negotiable regardless of who eventually acquires that controlling stake.
They have. And this strategy is pretty succinctly summarized by their phrase, switch to gas and fly up to green, which speaks directly to addressing the deep structural challenges facing the entire domestic chemical industry in Brazil, which is, as you said, fighting for its life against imports.
Yeah.
It truly is a fight for viability. The Brazilian chemical industry is facing its highest level of idleness in 3 decades, an astonishing 38% idleness rate right now.
38%.
Yeah. They are structurally disadvantaged against foreign competitors who benefit from cheaper feedstock, maybe lower energy costs, or more favorable tax regimes elsewhere. Braskem realizes that internal optimization alone just isn't enough. They absolutely need government regulatory support to survive long-term in Brazil.
So what specific legislative measures are they aggressively lobbying for to try and level the playing field, as they put it?
They're supporting 2 main regulatory mechanisms. First, there's Bill 89225, which aims to create the Special Chemical Industry Sustainability Program, or PRSIK. This program is designed to deliver tax incentives specifically to strengthen the sector's long-term competitiveness.
Okay.
But perhaps even more critical is their advocacy for the reinstatement of the special regime for the chemical industry, known as REIQ.
Right, REIQ. Tell us what that does and why reinstating it is so financially vital for them.
Well, the original REIQ provided an essential 8.25% tax benefit on feedstock purchases.
8.25%. That's significant.
It's huge. This tax benefit effectively lowers the cost base for local producers like Braskem, making their products immediately more competitive against imports, which often flood the Brazilian market without carrying the same internal tax burden. Losing that 8.25% benefit seriously undermines their domestic profitability. Now, they are, however, currently leveraging a component of the program called REIQ Investimentos, which allows them to secure a presumed PIS/COFINS credit of 1.5% specifically for capacity expansion projects, like the big Transformer Rio project.
Okay, wait. Let's briefly define PIS/COFINS for our listener, because these Brazilian tax terms get thrown around quickly.
Good point. PIS and COFINS are 2 major federal social contribution taxes levied on company revenues in Brazil. Securing a credit against these is essentially getting a tax break or a reimbursement on the inputs used for specific approved projects.
Got it.
So by leveraging REIQ Investimentos, Braskem is gaining a 1.5% tax advantage, but it's specifically tied to the construction phase of their crucial expansion projects. The real game changer, though, would be the full reinstatement of that 8.25% benefit on all feedstock. That would structurally shift the cost curve in their favor against those cheap imports.
Okay, so the strategy relies on both regulatory wins and internal optimization. Let's look at the 3 internal pillars of transformation now, starting with naphtha-based optimization. What does that involve?
This first pillar basically acknowledges the reality. that while they want to shift heavily to gas, they still own massive naphtha-based assets globally. So optimization here means maximizing profitability from the most competitive lines, like that Rio unit we mentioned that ran at 95%, and ruthlessly evaluating, maybe even cutting ties with, the worst performers. The management philosophy seems pretty pragmatic. Every single one of their 40 global production plants must generate positive cash flow, period.
And what happens to the assets that fail that cash flow test? Like perhaps that U.S.-Europe segment, which reported negative EBITDA this quarter.
Yeah.
What's the intervention plan?
They are undergoing intervention, according to management. This pillar involves seriously evaluating the hibernation, temporary shutdown, or even outright permanent shutdown of the least competitive assets globally. Factors they look at include age, technological obsolescence, scale compared to competitors. This is where the hard, potentially politically difficult decisions come in.
Yeah.
Do you invest more capital to convert a struggling plant to a more flexible feedstock, or do you simply shut it down to eliminate that drag on consolidated profitability?
Tough choices. Okay, the second pillar, gas-based expansion and flexibility. This is clearly the future focus, centered on that big Transformer Rio project.
Yes. This is the cornerstone of their structural resiliency plan. Transformer Rio aims to significantly expand the Rio de Janeiro complex by adding 230,000 tons per year of ethylene and PE capacity. The goal is to maximize the flexibility of their Brazilian complexes, allowing them to crack heavier feedstocks, including ethane, propane, and other lighter hydrocarbon components. This gives them crucial optionality for when naphtha prices spike, insulating them somewhat from the kind of commodity volatility that absolutely crushed them in Q2.
This expansion sounds massive. We noted our $233 million has already been approved for the conceptual and basic engineering phase. But the final commitment, the big final investment decision, the FID, it's hanging on one specific long-term negotiation, isn't it?
It is entirely contingent on securing a long-term ethane supply agreement. Without that guaranteed, reliable, and crucially cost-competitive feedstock supply, the economic viability of the entire $233 million plus expansion just disappears. This is why the potential Petrobras conflict we'll discuss in a minute is so pivotal. Transformer Rio is meant to be the strategic growth engine, but its ignition key is currently held by someone else.
Okay, moving to the third pillar, migration to renewables. This seems like their long-term hedge against structural market shifts and maybe a focus on getting premium margins.
Absolutely. Braskem is already a global leader in biopolymers, particularly their green PE, which is derived from sugarcane. The ambition here is high. They're aiming to expand bioproduct production to 1 million tons per year by 2030.
1 million tons.
1 million tons. This strategy leverages the growing investor and consumer demand for sustainable materials, which, as you said, often carry a substantial price premium. That gives Braskem a potential margin stabilizer in otherwise volatile commodity cycles.
So what are the current tangible projects in this green portfolio that they're working on?
Well, they have several key initiatives underway. There's the Sustainia joint venture, which is focused on producing biomag and bio-MPG. Those are bio-based glycols. They've also established the Braskem-Siam joint venture, aiming to build the first green ethylene plant outside of Brazil over in Asia. This decentralization shows they're committed to globalizing this green platform, not just keeping it domestic.
I did notice, though, the green PE utilization rate dropped down to 71% in Q2 2025. Was that a sign of weakening demand, or was it, as they claim, just normal inventory management?
According to them, it was purely strategic inventory management, not a structural issue with demand. After operations normalized at their Rio Grande do Sul complex following that severe weather event in the previous quarter, they had apparently run utilization high to rebuild inventories. So the drop in Q2 production was supposedly a deliberate effort to work through those accumulated stocks. And this is reflected, they say, by a jump in green PE sales volume in the same period, which suggests, if true, that the market for green PE remains robust, allowing them to manage production quite deliberately.
Okay, that makes sense. Finally, let's address the elephant in the room, the constant corporate uncertainty that really defines Braskem's public perception, that never-ending M&A dynamic.
Yeah, the source of the uncertainty is, of course, Novonor, formerly Odebrecht, the largest shareholder. It's essentially a bankrupt company desperately trying to offload its controlling stake in Braskem. This has led to years, literally years, of speculation, rumors, failed bids, and disappointments for investors who are hoping for a quick buyout premium.
And the difficulty of the sale seems multifaceted, right? Novonor needs a high price for its creditors, but all these issues we've discussed, Alagoas, the earnings collapse, the high leverage mean bidders, are likely demanding a significant discount.
Exactly. The process is reportedly ongoing,
Yeah.
with players apparently engaged in due diligence since late 2024, but it's been dragging on.
So what is management's position on this Novaner overhang? Are they focused on preparing the company for a sale, or are they trying to just ignore it and run the business?
They stress that their focus is entirely on execution of the transformation plan we just outlined. The key takeaway from current management seems to be a direct challenge to any potential buyer. They're essentially saying, any new controlling shareholder will inherit the exact same fundamental challenges: the cyclical trough, the Alagoas liability, the need for feedstock flexibility, the need for structural cost reduction.
Right.
Therefore, management asserts the transformation plan is the non-negotiable strategic path forward, regardless of who owns the company. They're basically saying, look, the price of this company will ultimately be determined by our ability to execute this strategy, not by short-term M&A speculation.
Okay, but I want to push back a bit on management's stated philosophy regarding asset sales, specifically those U.S. assets they acquired from Dow. They claim they're strategic, they generate cash, so they're resisting selling them just to deleverage. What happens if a strategic buyer comes in, looks at that 10.59x leverage, sees it as an immediate non-starter, and demands the sale of those very cash-generating U.S. assets just to bring the ratio down to, say, 6x immediately? Isn't that a likely scenario?
That is a very realistic potential conflict, yes.
Right.
While current management views the U.S. assets as generating valuable cash flow and providing strategic stability, a potential buyer might view them differently. A buyer might see them as the only liquid, high-value, arguably non-core assets available for a rapid debt reduction. If a buyer needs to quickly drop that leverage ratio, maybe to secure financing for the acquisition itself, or just to stabilize the balance sheet post-deal, selling the U.S. assets becomes an almost essential part of the M&A calculus.
So management might want to fix and optimize all 40 global plants.
But a new controlling shareholder might prioritize rapid deleveraging over long-term optimization. Absolutely. The M&A process nearly always prioritizes immediate financial de-risking, and those U.S. assets are currently the easiest, most valuable lever to pull for that purpose.
So the fate of the U.S. assets, despite what management says now, remains highly conditional on the outcome and the buyer involved in the Novaner sale process.
Absolutely. The overall management philosophy that any struggling plant must undergo intervention, be it optimization or shutdown, that will be the filter they apply. They clearly prefer fixing an asset over a forced sale. But the sheer financial strain of 10.59x leverage fundamentally limits their options when a strategic buyer with different priorities enters the picture.
Okay. Well, this has been an incredibly detailed and frankly often contradictory deep dive into Braskem today. We've really illuminated the immediate, undeniable pain. That terrifying 10.59x leverage, the cash burn, the deep Q2 earnings collapse, and those massive political and environmental overhangs, especially in Alagoas.
But equally, I think we've seen the clear counter-strategy that's designed to transform the company's very DNA. This strategy centers on three vital elements. Securing that gas feedstock flexibility, primarily via the completed Mexico terminal and the planned Transformer Rio expansion, fighting for crucial domestic regulatory support like PRSIK and REIQ to try and normalize their cost structure in Brazil,
Right.
and accelerating that high-growth green platform, aiming for 1 million tons by 2030. The transformation plan, look, if it's executed successfully, is designed to make Braskem structurally competitive long after this current painful cycle finally ends.
Which brings us neatly to our final pivotal thought for you, the listener, to consider. We talked about Transformer Rio being the absolute cornerstone of that gas expansion pillar, but its entire success hinges, as you said, on securing that new long-term ethane supply contract. And the source material flagged a really acute conflict of interest here.
Yes, this is the critical non-financial risk that everyone needs to monitor closely. The potential feedstock supplier required for Transformer Rio's survival is Petrobras. Petrobras is also a significant controlling shareholder of Braskem. They hold crucial board approval power over the final investment decision for that very project.
So Petrobras is wearing two completely different hats here. They are the supplier Braskem needs to negotiate a competitive, long-term deal with. And they're also a powerful stakeholder who has to approve Braskem spending potentially hundreds of millions on the project in the first place. What's the worst-case scenario if Petrobras fails to manage this dual role successfully?
Well, if Petrobras prioritizes its own internal supply requirements over Braskem's needs, or if it uses its shareholder position to extract overly punitive contract terms from Braskem, or maybe just drags out the negotiations indefinitely. It risks completely paralyzing the Transformer Rio project.
And without that long-term ethane supply.
The entire strategy to shift Braskem decisively away from expensive volatile naphtha in Brazil fails. Braskem would be permanently stuck battling those structural cost disadvantages. It would render the whole long-term transformation strategy essentially unviable, severely depressing its eventual sale value for Novonor, and basically confirming the market's current deep-seated fears that the company cannot internally resolve its critical political and structural feedstock problems. That negotiation happening somewhere behind closed board meeting doors between Braskem and its own shareholder supplier, Petrobras. That negotiation is arguably the existential threat to Braskem's entire future transformation.